okay, now I need to make a decision where to put my money, right? Cash flow we already talked about. Then we talk about the return, especially risk-adjusted return, and then tax benefit, payback period, risk management, right? So, okay, so when we talk about return, there are a lot of versions of return. So are we talking about the cash-on-cash return, meaning that you take out the final sell, because the final sell had a lot of uncertainty there, right? So we can put a number there, but how much confidence you have in that number is a question mark, right? So, okay, so one way to look at it is cash-on-cash return. And then another one is that we calculate the IRR, so internal rate of return. Basically, it tells you every year how much you can get from this investment over the whole investment period. So there are 4 versions of it. So one is unlevered. Unlevered meaning that you don't borrow money. When you leverage, of course, you juice up your return. But on the other hand, you're also taking more risk, right? So then one way to calculate is that, tell me what is the return if you don't use leverage, right? Leverage, of course, will be like multiple of the unlevered return. Second thing is that when you talk about the return, tell me, is it the before tax or after tax? Because a lot of people will not consider the tax benefit. They will think, okay, stock market, okay, sounds very sassy and then give me high return. But if you think about the tax benefit from real estate, if you compare apple to apple, the after tax return, real estate can be very competitive to the stock market. So here I'm just giving you some example, right? So leverage. So ATM, this specific deal, we don't use any leverage. Stock, bond, we assume that you don't use leverage to buy it. But multifamily, usually you borrow 60 to 80% from the bank. That means you can juice up your return. However, you also take on a lot of risk, especially when the time is uncertain. That can be a double-edged sword. Cash-on-cash return, as I explained, so the ATM deal, analyze the cash-on-cash is 21%. You can get your money quickly, within 4 years, 5 years, you can get it back. Multifamily, before the final sale, usually it's 6 to 8%, although right now I think it's becoming lower and lower. So it's a sign of late cycle. Stock, you get 1.3% dividend. Treasury, you get 1.6% coupon. Unlevered IRR, right? So before tax, so here is 12%, multifamily is 9%, stock is 11%, so the bond is 1.4%. So that's why I said this ATM, when you look at the cash flow, because it's so stable, you would think, oh, that's like a bond. But if you look at the return, of course, it's not the same thing, right? So, and then if you take into the tax benefit that ATM and multifamily receive, you will see, especially for high income people, like all the accredited investors in our investor pool, then here I'm assuming that this investor, their marginal tax benefit is tax rate is 40%. Then you will see a huge jump here because you are getting here is 100% tax benefit in year one. In year one, instead of like at the end of it, because that means you can save your tax payment immediately. So the more cash that you get, the higher return that you have, right? So here you will also see some benefit here, but because you can only get the 50% of tax benefit, here is 100% benefit. That's why there's a difference. For stock, you have to pay either the short-term or long-term gain. This is the ordinary income, so that's even worse. So now when people, a lot of time, they see this 13% IRR from multifamily, remember when they show it to you, this is the lever return, right? So the lever return, because it take on almost 70% of the loan, right? If you strip out that part, the unlevered one is just 9% or 10%. Depends on whether you're looking at. So you cannot take this 12% compared to this 13%, say, hey, they are almost the same. No, it's not the same, because this one, although it looks like a 1% lower, but the risk, there's no leverage here. You are the first one get compensated. There's no bank ahead of you. Anything goes wrong, you are the first one to get compensated. Here, 70% of the money goes to the bank. What if the real estate market tanks, right? So they cannot pay the mortgage, then the bank takes over and all your money are gone, right? So this, when you do the comparison, just don't look at the return. You have to look at it at the risk-adjusted return comparison.